Hello, fellow Rebel Capitals. Hope you're well. So, we have discovered the world's most powerful recession indicator. That is right. I've been giving this a lot of thought. I've been doing a ton of research on this. And today, I'm going to not only share it with you, but I'm also going to tell you what it's saying about the US economy right now. So before we get into the world's most incredible, powerful recession indicator that I've been keeping secret for quite some time, and you can tell by the thumbnail, JP Morgan does not want you to know about this. The central planners hate the fact that we're revealing something that is actually useful to you. That's right. You're not going to find this on CNBC, that's for sure. But before we get over to this recession indicator, let's go over some other things that may be contributing to the probabilities that we go into a recession. Now, I'm not saying that we are. A lot of people, oh, George, you predict and predict. No. Look, the only thing I've been predicting is that this cycle will play out the same way other cycles have played out, and that is with an economic contraction. Now, whether that's going to happen today, whether that started already, whether that happens in 6 months, I have no idea. And nobody does, quite frankly. But I just think that this time is not going to be different. Now, maybe it will be, but it's all just a game of probabilities, right? There are no certainties, only probabilities. So we have to look at data points like this. We can just bury our head in the sand. Now, if you want the bullish take, just buy. Well, I was going to tell you to look at CNBC, but more recently, just read Zero Hedge because they've kind of swapped. They've traded places going back to that movie from the 1980s. But anyway, okay, let's look at this. Broad continuing rise in delinquent U.S. credit card debt revisited. Now, again, you can say, oh, George, this is just fear mongering, or oh, George, this is just fake news, or oh, George, you're bearish, or blah, blah, blah. Look, don't blame me. I'm just telling you what the data says. You come to your own conclusions. Now, if you think that this means that the economy is strong, you're entitled to that position. If you think this shows how the economy is resilient, well, then that's up to you. I'm just giving you the intel. All right. So we've got credit card debt revisit, or delinquent credit card debt revisited. Now, this is from the Fed. They just came out with this about a week ago. So the percentage of people who are delinquent on credit card debt measures the incidence of financial distress among U.S. households. Okay, you would think that would be pretty important to predicting what aggregate demand will be. All right, let's keep going. And it is important to understand macro shocks affect the account. Okay, what I just said. With the context in mind, we documented in a May 2024 on the economy blog post that the rise in U.S. credit card delinquencies at the time was broad across geographies. Okay, so this is kind of an update on that. And the source, looks like from their data, we base our analysis on quarterly data from Federal Reserve Bank of New York, Consumer Credit Panel, and Equifax. We examined two variables, the percentage of people in delinquency and the percentage of overall debt in delinquency. Okay, I think that's smart. Now they go back to the first quarter of 1999 and they go through the first quarter of 2025. We begin by defining delinquency as credit card accounts with payments that are late by 30 days or more, but we also look at credit card accounts with payments that are late by 90 days or more. And then what they do is they break things down by rich and poor, kind of middle class. They do that by zip codes. So to better understand the broadness of the surge in credit card delinquency, we display data from the U.S., the Federal Reserve's 8th district, the highest income, 10% of zip codes, and the lowest, 10% of zip codes. So to be clear, this looks like they are sourcing, see, to better understand the broadness of the surge in credit card delinquency, we display data for the U.S. Okay, so they got the data from the U.S., then they've got the data from the 8th district, highest income and lowest income. Okay, great. Makes sense. So first thing here, percentage of people. So this isn't total credit card debt, just the number of credit card holders or the number of people with credit card debt that are 30-day delinquent, 30 days delinquent. And the blue line is US, red line, 8th district. So that's New York. And within the 8th district, we've got the green line, which is the lowest 10% zip codes as far as income brackets. And then we got the highest income 10% of zip codes is the yellow line. So obviously the yellow line is going to be dramatically below the green line, meaning that higher income people are going to be less delinquent on their credit card debt. But the trend, if you'll notice, is the exact same. And it bottomed out when? Well, when everyone was getting stimmy checks and no one had to pay their rent, no one had to pay their mortgage, no one had to pay their student loan debt. More on that in just a moment. But you can see we go all the way back to, I mean, even looking at the GFC, it wasn't as high. With the high income in the 10th or 8th district, it looks like we're right about the levels we saw during the GFC. And by the way, why did you see this go down so much? Because people are deleveraging. People are deleveraging. Well, yeah, people are deleveraging to the extent that they can. And then you see this bump right here. Huh, that is interesting. So these delinquencies, I'd really like to see the mortgage delinquencies. I'll bet you that's what really would have shot up during the GFC. But let's keep going here. So now they're going to look at the percentage of credit card debt that is 30 days delinquent. So this is overall credit card debt. So what percentage, if you have a pie chart of, let's just say $1 trillion, what percentage of that is over 30 days late? Okay, so this makes more sense that during the GFC, we have a big spike right here. So we have a big spike in overall percentage that is delinquent. But you don't have a big spike in the percentage of people. So what this tells you is that the people with the most amount of credit card debt are the ones that are blowing up, because the percentage of people that are delinquent didn't really change that much, but the overall amount of debt that was delinquent skyrocketed. Therefore, those who already had their credit cards, let's say maxed out or something like that, they're the ones that really just blew up. Subprime borrower. And yeah, you see that. So this would be the subprime within the subprime, or the subprime within the lower income zip code, let's say. And I'm just focusing on this yellow line, by the way. But you can see it went up as expected throughout the entire United States. But now, I guess that's the main point here. In the entire United States, we're almost as high as we were during the GFC. Although in the 8th district, the lower income bracket isn't yet as high. The higher income bracket is almost at the same level. Notice this green line. But the yellow line, although it's spiking up, and this is alarming, it's still not at the level it was during the survey, or not the survey sickness, during the GFC. Americans in more severe financial distress. So this is percentage of people with credit card debt over 90 days. So we see this bar. I wonder if this chart is just slightly off here. As far as the date, that would make more sense, because this is saying this was like, this big bump was like 2010. This would make a lot more sense if this was like 2008, 2009. it would line up a lot more with this. So percentage of credit card debt that is 90 days delinquent. Now we're getting close or closer with the bottom income. You're pretty much the exact same level at the high income. I'm sorry, guys. Forgive me. I've been doing this backwards. Forgive me, forgive me, forgive me. So I have been, long day. The yellow line is the highest income group, not the lowest income group. The green line, of course, duh, George, that is, they have the highest percentage right here. Green line, lowest income bracket, the lowest 10% incomes, zip codes within the 8th district. The yellow line, and I'm sure most of you have been hopefully correcting me in the chat. So, okay. I think you guys knew what I was trying to say there. You guys are probably smarter than I am. Okay, so the green line would represent the low income. And going back to this chart, okay, so the low income, about the same as it was during the GFC. The high income is a little bit lower. U.S. overall, almost, we're getting darn close. We're just a shade under where we were during the GFC. Summing up the trend, our blog post investigates several measures of delinquency and found out overall, the trend is rising. Credit card delinquency is widespread and continuing, even though the pace of the growth has slowed since the beginning of 2024. The present share of credit card debt in delinquency is reaching levels seen in 2008 global financial crisis, and the share of people in delinquency has surpassed levels from that time. This is surprising, given that labor market is significantly stronger. Maybe, just maybe, the labor market ain't that strong. Just because the unemployment rate is low doesn't necessarily mean that everyone's got a fantastic job. Or I think a bigger takeaway would be, okay, just because everyone is employed or maybe has multiple jobs, side hustles, it doesn't necessarily mean they're making enough to pay their bills. Because wages went up, let's say like this, but if prices of stuff went up, you got a bigger delta. So at the end of the month, people are finding it harder and harder to make ends meet. That would be my takeaway from this, from the fact that the unemployment rate is low, yet the credit card delinquencies are skyrocketing to the point where we're now at the same level, or roughly the same level, that we were during the depths of the GFC. So I wanted to point this out. This, I think, you have to factor into the equation as to the probabilities we go into a recession. But this isn't the indicator I was talking about. Let's go over to another one. Here, at 0. Okay, here we go. Student loan delinquencies surge. So now it's not just about credit card delinquencies, it's student loan delinquencies. Why? Because the Trump administration pretty much got rid of whatever Biden was doing, which was kicking the can down the road and letting people, he was either forgiving their debt or he was saying you didn't have to pay it yet. And most of us think, oh my gosh, the stimmy checks. Well, that was like 5 years ago. Well, kind of, but kind of not. Most of you probably don't have student loans, so you wouldn't know. But people, a lot of people, a high percentage of student loan borrowers have not had to pay their student loans since the Cerveza sickness. And they are just restarting. Let's look at this. So the party is over for 1 million Americans who paused payments on their federal loans. Okay. Over the last several years, through the Cerveza sickness forbearance programs, many had hoped the sweeping loan forgiveness under the Biden administration. But with federal government officially resuming collections on defaulted loans this month, for the first time in over 5 years, borrowers now face sliding credit scores. So now this is going to impact their credit score. I don't think you can, before, you couldn't get rid of this in bankruptcy. I assume the laws are the same. While April, we warned, okay, on Tuesday, the Center for Microeconomic Data at the New York Fed released quarterly report on household debt and credit. Okay, so there is the delinquency status. But is this for, I don't think this is for student loans. That's overall. Here's your student loans. And look at the red line. Exactly what you'd expect. So we have the student loan delinquency was, let's just call it 12%. And then when everyone gets stimmy checks, of course, that plummets, or not just stimmy checks, but the fact that they didn't have to pay their loans and they could just indefinitely put them off. Of course, if you don't have to pay your loan, then that means that the delinquency rate is going to go down quite substantially. Go figure. So that takes us to 2023. It keeps on going down, but now all of a sudden they got to start paying it back and it just rips higher. I would assume this is going to go a lot higher than it was prior to the cerveza sickness. So let's say it was at 12%. I would not be surprised if in a month or two this is at 15. But this is the big, kind of like jaw-dropping moment here where we realize that the average student loan payment is about $400 a month. And if you've got millions of people that are now having to pay that $400 a month that they didn't have to pay before, not only has their wages not kept up with the rate of consumer price inflation, but now all of a sudden you layer this on top of what they were struggling with before, and there's just no room in the paycheck. And so this is, again, it's just like the credit card delinquencies. I don't know how you can argue when you look at data points like this that the probability isn't increasing. Again, no certainties, only probabilities, but the probability isn't increasing that you have a contraction in the economy. And maybe that's not even a recession. I don't know. Maybe that's just nominal GDP growth continuing to go down. Maybe that's a couple quarters of negative real GDP growth like we saw in 2022. Maybe that's it. Maybe the unemployment rate doesn't spike to 7, 8, 9%. Maybe we don't have a balance sheet recession. I don't know. We've got nominal growth declining. That's what we're talking about here. Okay, so now that we've done that, let's go over. Josh, go ahead and hide my screen, buddy. I've got to go over to my email real quick because I forgot to pull this up.
Okay.
So now we go over this recession indicator that I've been working on. I want to share it with everybody because it's something to a certain degree we've talked about on this channel probably about 6 months ago.
All right, we can see this.
Okay, great. Whoa. Man, I don't know why this is so touchy. My goodness. Can I just... Okay. Well, you guys, okay, you can see this for the most part. And I guess, can I zoom in on the top part or just, no, it keeps doing this. All right, I'll go ahead and read it to you guys. So what I want to start off with is the number. Well, if I just had one metric to tell you whether or not we are in a recession, this would be it. If I just had one metric. Now, the indicator that I created, it has a lot more than just one metric. So I think it's a lot stronger than this and has a higher predictive ability. But if I had to choose just one out of all the research I've done over the past 3 weeks or so trying to build this, I've used AI, and I mean, I've been really putting a lot of hours into this. But if I had to choose just one, it'd be non-farm payroll. It'd be non-farm payroll for sure. And I know that they adjust it down and all these things, but this is just headline back in 2007, 2008. This was before the adjustments. So we can see January. I wonder if I could. Okay, so we can see, Josh, make sure you've got this enlarged to the extent you can. January 2007, we're at plus 111,000. And then for the entire year of 2007, you kind of jump around a bit. It goes up to 180. We had a negative 4,000 in August. but then it jumps back up to 110 in September. And then when the Fed starts cutting, it's at 110. It's 166 in October of 2007 after the Fed started cutting. And then even in November, it's plus 94. Looks like December 2007 plus 118, plus 18,000, excuse me. But then when we hit January, it's when the stuff meets the fan, so to speak. And we start to see consistent negative numbers. And again, these are not revised, guys. This is what the headline. The revisions were even lower. But in January of 2008, we get negative 17,000. Then we get a negative 63. Then we get a negative 80. We get a negative 20. We get a negative 49, negative 42, 62, excuse me. So you can look at every single month in 2008 and non-farm payrolls were negative every month. And then when we get to the stuff really hitting the fan, in September, it was negative 159. And then boom, Wild E Coyote, October, negative 240. In November, negative 533,000. Holy smokes. And then December, negative 524,000. So it's a little bit of chicken and egg, chicken or the egg. From the standpoint of the NBER uses this to declare when a recession hit. So did the recession hit at the beginning or the end of 2007 or when they declared it, January 2008, just because the non-farm payrolls went negative? Who knows, right? For the average Joe and Jane, I don't know if they can tell the difference. If you lose your job, do you really care whether or not the NBER says that we're in official recession? Of course not. It doesn't matter to you. This is just wonky stuff. But the bottom line is, if you are basing your definition of a recession on what the NBER says, then if you had to choose one metric, if it's me, this is it, non-farm payrolls. And what we see recently is we do see non-farm payrolls declining, but they're not negative. They aren't negative yet. Now, they're on a bad downward trend, that's for sure, at 177. But the next couple months, non-farm, I think, are extremely, extremely important. And if you see those non-farm payrolls go negative, especially for 2-3 months in a row, then regardless of what the NBER is saying, you can bet that the odds are that we are in a recession. Okay, now this is a component of the indicator, but it's not the entire thing. Now, nor is this, but these are some components. So I had two indicators or two sub indicators that I combined into one. So one was one that focused on kind of timing. And so I forgot what I called it in the GPT that I was building, but one was like not advanced. Anyway, one was like tried to determine, like pre-recession, like when we're ramping up. And the other one was to deter like a confirmation indicator. That's what it was. Leading indicators, confirmation indicators. So these are some of the leading indicators. Now, they're not always leading, but sometimes they are. Combining it to one, I think, is pretty powerful. But the overall indicator has the leading and the confirming or confirmation indicator or specific data points. All right. So what we do here is we look at initial jobless claims, continued jobless claims, the 2 to 10 year Treasury spread, trucking jobs, transportation, and construction. So then I went ahead and I followed the whole Deutsche Bank. We did a story on this probably 6 months ago, and it was very popular. So what I did is I took the 10 or so data points Deutsche Bank, and I added another 10 or 12 that I thought were extremely important. And so what I've done is I've taken that and I've really back tested it and refined it down to something that I think is very powerful. And then I gave it the whole red, yellow, green. Now, Deutsche Bank did the opposite. They did a green, meaning the Fed should cut because we got problems. That didn't make sense to me. So I switched it to red. So 2007 to 2008, the initial jobless claims, that was red. That was red. So it was, let's see, 2008, it was 70,000 year over year versus a plus 12, because that doesn't help us too much there. But the bottom line is it was a heck of a lot worse in 2007, 2008, when the NBER claimed we were in a recession than it is right now. It's not good right now. The initial jobless claims kind of spiked up, but they're still at a very low level. So the fact that they spiked up the other day is why we're in the yellow, but they're still very, very low, which is why we're not in the red. So the initial jobless claims, if my memory serves me right, during that time, we were probably up over 300,000, 400,000, or ramping up to 400,000 in 2008 or so. The continued jobless claims elevated in both periods. So we've got a red signal here currently in 2025, and we had a red signal 2008 recession. The 2-year, 10-year spread, red and red, because why? Usually you see the stuff hit the fan after the curve is no longer inverted. So we invert, that's risk off, be careful, and then we uninvert, the curve starts steepening, and that's usually when stuff hits the fan. So red in both cases. The truck transportation jobs, red, meaning a steep decline back in 2007, 2008, now yellow. We are in a little bit of a decline year over year, but it's not that bad yet. Construction jobs were to green. Back then, we were declining significantly, and now we're still, according to the Fed, we're still increasing construction jobs. So what's the main takeaway from just this subcomponent of the overall indicator that I wanted to share with you guys? The main takeaway is we've got problems. The economy is not running on all 8 cylinders. That's for sure. But is the economy at the point where the NBER would claim we are in a recession right now? Probably not. Probably not. Because we've still got greens, we've got yellows. And why does this matter? Because if you're setting up your portfolio for the Fed dropping rates dramatically in the next 2 months, I would hold off on that. It's not investment advice, but I'm telling you, I think the cycle is going to play out the same, which means the Fed's going to drop substantially, way more than the market is predicting right now over the next, let's say, 12 months. But am I going to put on that bet right now in my own portfolio? The big bet? No, I'm not. Because we've got yellows and greens. I'm going to wait, and you do what you want. Again, this isn't investment advice, but I'm going to wait to place the big bets on the Fed dropping until we get all red. And what's great is I've got a bunch of inputs in here that I'm not going over today, but I will go over them on Friday. We're doing a webinar in Rebel Capitalist Pro at 11 a.m. Eastern time. So if you guys want to participate, and I'm going to do an even greater deep dive into each and every metric that goes into the overall indicator that I've been working on, which I think is the most powerful indicator in the world. I absolutely do, especially with the back testing that I did with AI. And if you guys want to go into that deep dive, you can join us there 11 a.m. Eastern time, and you can sign up at it's georgegammon.com/pro. You can do a $1 trial if you want, or you can just sign up for Rebel Capitalist Pro. It's a great service. But then you can participate in that live stream, or if you don't have the time to do it, then at 11 a.m. Eastern time, you can watch it at your convenience. It'll be posted on the homepage of the forum. I also want to state that we're going to be doing a deep dive on this, but we're also going to be going over some big changes that I've made to my own personal portfolio based on the conclusions I've come to by doing all of this research and creating this indicator to begin with. I've got a $100,000 portfolio in there and a $300,000 portfolio. So $400,000, almost $500,000. And it's not paper trading. It's real money. So I've made some big changes just at the beginning of the week. And I'm going to be going over that and sharing exactly what I did and why on Friday morning, 11 a.m. Eastern time. So guys, head over to georgegammon.com/pro and sign up for that. This is something that you're not going to want to miss. All right. Enjoy the rest of your afternoon. As always, make sure you are standing up for freedom, liberty, free market, capitalism. We'll see you in the next video.